and understanding the use of the financial statements from the perspective of a manager. So, but in order to get a good foundational start, we wanted to start with the basics. So I'm going to say right up front, if you have any questions at all as we go along through the slides, please don't hesitate to jump in, because you really want to have a good understanding about the basics in order to do the next session. And that was the other thing we talked about, and we'll define in the next meeting tonight, but we wanted to split the finance sections into two pieces, just because we want to try and keep this session to an hour. It's once we get beyond that hour, it just gets a little bit harder to retain everything. And so we will do the basics tonight, and then Larry will move in and we will do on the ratios and understanding that as managers and how to use it for your farm business. So we will get started. Okay, why is my slide not moving?
Uh-oh.
Hold on. Okay, I am on huge delay.
I lost you completely now. No, I didn't. Well, it moved over. It did change. I can see your second slide now.
I know, but it's not letting me progress at all here. So, Larry, in the event of technology, do you want to move over? And you're going to, this isn't helping me to open this again. Switch it over to your computer and we'll just go through the slides using your as a presenter.
Okay, so it's going to take me a minute to find them.
Oh, hang on. Hold on. We're back. Okay.
What's the matter?
It's unlocked, so it's movable. We're good to go.
Okay.
Okay, so what we want to talk about are what are the objectives of the finance module that we want to talk about tonight and on the second presentation. So understanding the basic principles of finance. So there's cash, there's profit, and there's value. And what are those financial requirements of the owner? Understanding finance from the perspective of the manager. So we're going to be concentrating on financial statements and operating management. And the intent is to connect strategy, planning, and budgeting all together, because obviously all those things have an impact on what you do with your business going forward and what the strategy is and how you could take some advantage of the opportunities that are presenting themselves. So we really want to demonstrate and give you some information. And I do want you to keep in mind that once we get into the ratio stuff, obviously within C-Team, we get into depth into a number of ratios, but we're going to try and touch on a few of them to give you some good information to at least get started. So, and the third financial objective is understanding investment. So in terms of the financial structure, the ratios, the working capital, the capital investment, and the sources of financing. And those will make up a good part of the second, or actually all of the second piece that we will be doing. So what are concerns for a manager? So obviously, we all make decisions. We make the large decisions in terms of what we're doing, the investment required, trying to identify which investment is actually the correct investment, financial planning, assessing where, what is your opportunity cost, how to plan for that, how to cash flow, looking at seasonality. We all have obviously seasons where our cash flow is greater than other times of the year. Securing and managing funds. So that is in terms of making an investment and securing your operating funds, perhaps making investments in other companies or other opportunities. And financial controls, measurement, and analysis. So all these things are things that a manager focuses on. So can you guys think of anything that you want to talk about from your perspective in terms of your job roles, and what are some of those things in there that you're responsible for?
Are you there, Heather?
Yep.
Yeah, Curtis Cadet here. So my year end is December 31st, and I guess throughout the months of November and December, I did a lot of tax planning for my year end. So I fiddled around with all of these financial statements, and yeah, I utilized this managerial perspective in the tax planning business that I did before the year end.
Okay, so Curtis, do you use it beyond the tax planning in terms of, do you look at your ratios within your financial statements?
Yeah, so I guess tax planning is one thing, and another thing would be, well, I have a meeting with my ag lenders at the beginning of every new year, and so I use a lot of financial statements to show lenders how I'm doing in the business and what my, I guess what my borrowing capacity would be, and you know, whether I can afford to, you know, buy another quarter of land or a piece of equipment.
Okay, so with your accountant, do they give you any feedback in terms of where they, based on the information in your financial statements and how they are structured? And that's one of the things that Larry will talk about is financial statements with different accountants can be structured differently. And that is one of the things that we're trying to work with. But Curtis, I guess that's my question is, do you get much feedback from your accountant in terms of your ratio analysis? So your return on assets, your return on equity, your debt to EBITDA, any of those type of things? Or is this all new to you?
Well, I can't say I'm overly experienced with these ratios. I've come up with numbers, so I kind of have an idea of what they are. And as for like, I can't say that my accountant really has given me any we haven't really discussed them. We've discussed them a little bit. Like they're relative. They seem to be relatively healthy, so he hasn't really mentioned too much. I know my accountant is pushing towards transferring my company into a corporation, but yeah, that's about all I can say on that behalf.
Okay, and that's okay, because that's why we're here, is to kind of give you guys some information so you could start asking the questions or start making the calculations, start understanding your financial statements first, and then being able to use that information. So we will, that's a perfect fine answer. So bottom line is we're going to discuss finance, which is different than accounting, and we're going to be discussing it from a manager's perspective. So the first management issue, it's managing cash. So I mentioned the aspect of seasonality. So for us, we're grain farmers. So obviously our cash flow is greater within the months of August to probably April, when we try and clear all the inventory out. Every type of farming commodity except for probably the supply management, where it's regular checks each month, will have some seasonality to it. And regardless what it is, and depending on where your cash projections, and we're going to talk the difference between a cash flow statement and cash projection, but it's understanding where your cash is going to be short, so where you're going to need extra cash injections, or where you're going to have extra cash that you can either utilize, invest for the short term, or what to do. But you really, that's one management issue. It's failing to understand that cash flow projection. The other one is in terms of managing your working capital. So it can come down to receivables. So any of you who have checks out there, making sure that you're getting paid before the 30 days, the 60 days, or the 90 days sometimes, depending on who it is or what it's for. But making sure you collect those things on a very timely basis. But on the opposite side, in terms of your accounts payable, it's making sure you take advantage somewhat of your timelines on supplier credit. So if you have the 30 days dating, using that, or if you can negotiate deals. I know there's certain fuel companies out there that in August you can buy all your fuel and it's not due until November 25th. So that's managing your working capital. You might as well work on their dollar versus your dollar. And it's also controlling inventory. So making sure you're dealing with inventory in a timely in a timely fashion, so you're not having spoilage. I mean, there's advantages to storing, but you have to assess what all those costs are and what are to your benefit and financial benefit. So failing to manage working capital. The third one is failing to manage your costs and your margins. So it's assessing. We talked a bit about doing enterprise accounting, or even taking a look at your gross margin, identifying the eroding margins. So is it a matter of your input costs and your sales are not working well? You either have to be reducing your input costs if your gross margin is not enough, or increasing your revenue. So you need to identify that. Or is it below, is it your contribution margin that is needing to be looked at? What is some of those costs that you need to be considering on reducing? It's using cost and price hedging. So for those of us, for fertilizer, we tend to be buying it early because the price is less. We prepay a lot of our seed because the price is less. Or if you're selling, using price risk management tools to optimize and protect your pricing. So there's factors that you need to look at there, and if you're failing to manage it, it's costing you money. Negotiating more effectively, whether it's with your suppliers, your lenders, any of those, but using that negotiating skill to your best cash advantage. And this is a big one, controlling your selling, general, and administration costs. And Larry, you have a different name you're using, not SG&A, but these are some of the
operating overheads.
Okay.
Yeah, it's just operating overheads.
Okay, so this is one category that can sometimes get away on farms. I know as farmers, there's lots of times we're trying to put as much stuff as we can through on the expense side. But this is one category that you really do need to be conscious of, and because you can lose dollars in that. So the thing you want to remember is cash is king. So you want to be looking at the ways to manage your cash and use it appropriately and to save you cash or make money. So the second management issue is over-leveraging the business. So we can borrow for low return investments, unrelated assets. So you can see a lot of things that are running around on farms that really aren't having a return on investment, but they have significant dollars that have been paid for them. Consuming the operating line. Operating lines are not supposed to be used for capital expenditures. That's why you have term loans or for principal repayments. So you need to be very conscious in terms of where your cash flow is being used, and overlooking reality. It's really easy to justify something by being creative. I'm saying creatively constructing returns for proposed investments and future events, but you really need to be realistic on any of the things that you're considering when you're doing your budgets, whether it's for a capital expense or for your operating budget. Being realistic is key, sometimes being conservative or having different scenarios to really identify what the impacts are in terms of costs or interest rates. So reality is important. Any questions so far? Okay, we'll move on to the third management issue, and this one is failing to communicate responsibly. So being a manager comes with some responsibilities, whether it's to your employees. So for those of you who have siblings in the operation or parents who are still involved, or you're involved with your parents, communication is really key, so everybody's on the same page. With investors, if you're a shareholder in the company, or if you have lenders that you're needing to report to, if there's issues or concerns, or you've went through a program like this and you're proud of the project or the plan that you've done, communicating it with them so they understand what you're doing. They're kind of one of the key ones that you want to make sure who are always in the loop. And with government, so specifically CRA, regulators, these are the ones that you really want to stay up to date. Communication, if there's a lag, you want to talk to them and make sure the communication line is open. So communication is a huge thing, whether it's family, employees, investors, or government. You want to ensure that you manage that correctly. So what we will say is finance is not accounting. So when we're talking about finance, we're looking about going forward. It's the fuel for the machine, for the business. We want to understand the risk and the reward of the considerations that we're making. We're talking about cash flow, cash projections, and valuation and capital structure. Accounting, on the other hand, we're looking backwards. It's a record of what's happened, what's transpired. It's about controls and processes, and it is typically risk adverse. So you're really taking a look, it is keeping score. So we want to be taking a look at these financial statements and looking at the numbers that have been collected from the accounting side and using them to look forward and take advantage of those opportunities or pull in where we need to or continue. Larry, do you have anything you want to add? Yeah.
Yeah, that's the one. There's an interesting, almost conundrum in this slide for me, and that is, I think I talked about this the last time when we were still talking about planning, and that is that I do think you need to understand your history as you're doing your strategic planning stuff. So I think I mentioned this. I've given too many talks lately, so I'm not sure who I said what to, but I think I talked about the fact that I think it's important that you have some of your fundamental ratios when you're doing your strategic planning process, because they are going to tell you where you have strengths and weaknesses, if you will. Heather talked about debt to EBITDA a while ago. If you have a lot of debt relative to your operating income, that you're not going to be able to grow very fast. So that kind of thing is going to be is going to have a major impact on your growth and that sort of thing. So history is important because it tells you where you are and where you've been. But it's also absolutely correct that use that history and then figure out how do I need to budget differently and how do I need to operate differently in the finance area going forward. So to me the finance versus accounting isn't quite as cut and dried as I used to think it was, as this slide implies, but there's certainly a fair amount of interaction there. So I don't know if that helps or hinders, Heather.
Okay. No, I think that's good. Anybody have any comments, any experiences they want to share, anything that they do at this point?
I was going to ask Raj back there. I think Raj, you said you worked for Farm Credit at one time.
Yep.
This is probably on the slide before, but one of the things we like to tell people all the time is if you're getting in trouble, if you're having trouble financially, don't wait until you're really deep in trouble before you tell your banker.
Definitely.
I think it's really good to let them know ahead of time. Lots of times they'll work with you.
Yeah, because just from my experience at Farm Credit, Farm Credit doesn't want to get possession of your farm. They'd rather just collect the interest and help you structure your business differently. One example that I can think of is there was a greenhouse grower in the Lower Mainland near Vancouver, and his greenhouses were losing money, and then so they structured the business to start producing only butter lettuce, and they also sold off some of his properties. And after I think maybe 2 or 3 years, he was back on his feet.
Yeah. That is absolutely the other side of it. They're talking to people with experience who can actually help you figure out what to do about it. So, okay, Heather, I'm fine.
Okay. So cash, it is all about cash. Who has it? How do you use it? What you do with it? And along the way, there is lots of different words, lots of different terms. If you don't understand something, don't hesitate to ask. And if we don't know, we will find out for you. So I think that's one of the things that we're really trying to find is cash can hide in different places. And, you know, if you are careful in managing all your aspects, it gives you certain advantages. So cash is king or queen or both. It's easy to invest, but it is harder to cash in. I think we can, sorry, go ahead.
I was just laughing. Absolutely. It's easy to get into agriculture. Sometimes it's really hard to get out, or any kind of business. Yeah.
Yeah, and there are lots of different places where you can let it hide. So if you're really diligent in trying to follow up on some of the things that we've talked about in terms of what some of the management issues are, you can find those extra dollars and utilize them better. One thing to remember, and Raj, maybe you want to mention too, but banks always get their money. I think they're always the first one to get paid, so always keep that in mind. And tax biases versus for business decisions. The biases and the influence, but they shouldn't drive the decisions. So I have issues when people are buying machinery simply for the depreciation and not doing a full budget on it to say, you know, what is my return going to be on this investment? It's a quick decision and it's influenced by tax. That is not typically the best reason to be making a decision. And it's something, you know, we always get people to be looking at, and that goes back to the machinery management program that they're doing this week in Alberta and Saskatchewan. Larry, do you have anything to add on that one? I thought you may.
Well, I can add on a couple of things, but yeah, I mean, I often see too many people make too many bad decisions especially to buy something because they want to save tax. And it's a really bad investment sometimes. And you know, you save $2 on tax and you lose $400, you know, because of the investment. It makes no sense at all. And in fact, what we're doing with this machinery management stuff is a lot of capital budgeting that allows you to actually take into it, you know, like allows you to get away from the emotion and the quick decision to save tax or to take the sale, take what's on sale at the moment. You know, the special that's available until Monday morning on the combine that you don't really need, that sort of thing. So, yeah.
I just have a question for you, Heather and Larry.
Yeah.
So if you run into a tax issue and you need not necessarily equipment depreciation, what would you suggest to do to fix that tax problem? Like, what's your suggestion? I know you can pre-buy expenses or.
Are you incorporated or sole proprietor?
Sole.
Okay. I think my first thing would be, if you're running into tax issues, I would definitely look at the incorporation. Just that would be in a conversation with your accountant, just because the tax rates are different. But I think one of the things you need to be conscious on, you can manage your tax to a certain point, but you're really only deferring it. Yeah. I know we're conscious. I know for ourselves, our year end is in November. It used to be in July and we switched it. I'm much more conscious now on watching the grain sales. I know you obviously want to time them according to what your payments and stuff. but you really are conscious. It put me in a different position now than my year end was in July, because now we can sell grain until November. So you can be selling a lot off the combine to free up bin space, but you really need to be conscious, and it comes back to good tracking. And I don't think it's a bad thing to always pay tax.
Yeah, I agree with you. And also, I've been utilizing optional inventory adjustment. What's your take on that?
I've never used it. I've usually just managed it elsewhere.
Gotcha.
Yeah.
Yep.
Yeah, and I haven't even run into it. So.
Well, and we did for a couple of years. We were buying when we could. It was a few years ago now. Now they don't let you do it, but we were buying large amounts of barley and then selling it back, and it just buys you a problem. So, like I said, you're basically just deferring your tax.
Okay.
So. So the risk return trade-off. So obviously with any investments, the higher risk, the higher the potential return. So the lower the risk, the lower return. So basic principles. Competitive markets. If it's something that you're doing that's high margin, you always need to be keeping on top of it and staying ahead of the game, because somebody else will always be right behind you to seek out that high margin and do what you're doing. So there's advantages if you have the cash available, that it gives you that extra advantage to take advantage of opportunities before those who don't have it available. And the money has a time value. So when we're talking about capital budgeting, $1 today is worth more than $1 next year. So those are some things that when you're thinking about, and you could be using this in terms of a capital budget, that when you're looking at an investment, you're going to be looking at the amount of the risk, what you're expecting for a return, what's your opportunity cost, and the time value of money, and how all those factors have an impact on that investment and the consideration. So without getting a lot into capital budgeting, which is a whole other 2-hour seminar, it is just some quick principles about what those things that you need to be thinking about. So operating cash. So the money that we get from EBITDA serves 4 masters. So we have our capital, so it's going to serve our working capital, the purchase of the fixed assets and the intangible assets. It's going to be paying our principal and our interest payments to our lenders. It's going to be paying to shareholders. So depending on your farm structure, how you're taking your management fees, whether you're taking it through dividends or whether you're taking it as wages. If it's through dividends, obviously that EBITDA is also going to have to be paying you as a shareholder through dividends. The yield and liquidity. And obviously the government, our taxes, our employment, source deductions, and the investments. So there's 4 things that need to be considered out of the EBITDA that you're going to be looking at from your income statement. So do you have a rule? Sometimes it's rule of the thirds, but it's to pay the appropriate taxes and then distribute the operating cash to the 3 consumers of the cash. So that would be your capital assets, your debt financing, and the investors. So what is your rule? That is for you to define. Choose your balance, but the key is to be disciplined once you decide what that rule is and continue with that. Obviously you want to review it, but it's one of the things that you need to consider when you're looking about where is that cash going and who are the people and how much will be going to them. Any questions there?
Can I just add one thing?
Yeah.
You'll find out that I really focus a lot on EBITDA because what it is the ability of the business to generate cash. If you want to grow, it has to. unless you got a rich uncle. Okay, it has to do that. So that when we get into the ratios, which we will the next time, I think this is one of the most important things to understand. If you're going to grow, or if you're going to pay for your debts, you've got to generate a fair amount of EBITDA. We had one guy come through the program a few years ago, and his banker suggested he do it. He's president of a fairly major company, and I knew his banker, and his banker said, I'm sending him to the course because he needs to understand the concept of EBITDA. He doesn't get it. If he wants to grow, if he wants to borrow money, if he wants to borrow more money, he's got to generate more cash out of the business, and so forth. So anyway, maybe that's enough said now until we get into the next part.
Okay, so this is one of the questions that I want to open up to you guys. So what if one of the challenges or the successes in financial management that you have that you're willing to share with the group, or your experience in working with your lenders, but we'd really like to get a little bit of feedback from you, and then learn what your financial management goals are through the program, but even in the next few years. So Carmen, can I start with you, because I know that that was something that you had identified.
Yeah, so on the previous slide, you had the rule of thirds, and one of the people there was shareholders. In our case, we take very little money out of our farm, and that's something that I would like to look at for us, is to see, can we even afford to take money out? Because the idea has always been that we should throw it back into the farm to fuel our growth. But we've never calculated anything and have no hard numbers to back that perception up. So I would really like to know, like, are we actually even making a profit? Because the strategy my husband's always worked under is that we're farmers, we need to have on paper that we're losing money every single year for tax purposes. So there's a lot that I would like to learn and have made more obvious, I guess, out of knowing our true financial position. And let's see, one or two. I guess the other one would be to have more backup when we are making financial decisions. One thing that we did last year was purchase a quarter of land, and it was the first one that we purchased inside of our corporation. And that seems to really throw in all of our ratios into a tailspin, looking at them a year ago as to now. So it would have been really nice to have that kind of thing to look at and understand what it meant prior to making that purchase decision, just to make you feel better about it and know if it truly is a wise thing, or even for something smaller such as equipment.
Okay, good, fair enough. Curtis.
Okay, I kind of like what Carmen said. I'm kind of on the same page as her, unfortunately. Basically, a challenge I find is to figure out my financial position. Like, I've been farming for about 8 years now, and I've grown a lot in the last 3 years since I've graduated university, and it's a little bit overwhelming sometimes. Figuring out really what I have in store, and I'd like to do this in order to create a goal of mine is to have a better grasp on my financial situation, to have a better handle on making capital expenditures, and just sitting down and having conversations with farm lenders.
Okay.
And yeah.
Thank you. How about Raj?
One of our big financial management successes has been utilizing Farm Credit's 1-2-3 Grow loan. And with this loan, you can borrow money, and you only have to make interest-only payments for the first 5 years. So for our instance, we bought more land in 2012, and we began planting high-density apples. And so during this time, it helped us with our cash flow management because our payments were so much lower because we weren't paying any of the principal. And now our farms come into production, and now we're able to make all of the principal payments as well.
Yeah, that makes so much sense in that industry, especially.
Good. So Raj, was it you who worked, I can't remember, who worked for FCC?
I did.
Oh.
Okay. So as a lender, if you were to say, give everybody one thing that they really need to know that is of value when going to talk to your lender, what would that be?
I think it would just be your debt to equity ratio. That is the most important one, because one thing that FCC that I noticed does is the valuations they do on your property, they don't tell you what they put them at. And I also noticed they're very conservative. So even if we say, oh, so-and-so neighbor down the street sold their land for 20,000 or 30,000 at the top end, that doesn't necessarily mean that's what your lender is valuing your land at. So it could be a lot less than you actually think. So you really have to manage how much debt you're taking on.
Okay, and it's about understanding what your lender is looking at specifically.
Yeah.
Okay, thank you. Travis.
Yeah, so I'm still a student, so I haven't had a whole lot of success financially, mostly just taking on debt to pay for school. But I think I'm kind of going to be echoing a bit what's been said here before, but the biggest challenge for us is to separate personal and farm business. When my parents went from sole proprietors to corporation, and it just is all kind of mixed up. So that really has been a big challenge, I think, for them as far as making decisions about growth, moving forward, succession. You can't really figure it out you can't really make plans to move forward if you don't have your stuff figured out where we are right now. So financial management goals, I guess after talking with my parents and the rest of the family, and personally, one of our goals is to utilize some of our advisory team, our accountants and our bankers more so as advisors rather than people you just kind of push papers towards and say, either do my year end or for the banker, can we afford to pay for this farm? Have it more, where they're a part of your strategy team and you guys are on the same page and kind of working together rather than them working for you. So, yeah.
Good point. I like that, actually. Okay, good. Well, from there, I think I'd like to move into the financial statements, and it locked again.
Your arrow's moving.
I know, but this. Okay, there we go.
There you go.
So I had sent everybody out because we wanted to kind of start at the basics and a good basic understanding. I did send out this document from Merrill Lynch. I know it's American, but this is the best one I've actually seen that actually just kind of gives a really good explanation on the income statement, the balance sheet, and the cash flow statement. So I hope everybody had a chance to read it because it does kind of give you the foundations on how and where the numbers come from. So any questions, or did everybody get a chance to take a look?
Yeah, I looked through it before the training today.
Okay. Anybody have any questions about what they saw in it in terms of where the numbers come from? We won't talk about the ratios yet in terms of the analysis of this financial statements, but at least the basic structure.
I found it helpful. It was a good document, Heather.
Okay, good. Yeah, I actually thought I was happy with it. So I'm glad that helped. My other question is, how many of you are filing or are incorporated or filing as sole proprietors?
As I mentioned earlier, I am filing as a sole proprietor.
Okay, and that's Curtis, right?
Yeah.
Yes, ma'am.
Yeah. Okay. And Raj, you guys are incorporated?
We're in the transition to incorporating because now we're actually making profits. Before we were just having losses every year.
Okay. And Carmen, you said you guys were incorporated?
Yes.
Okay. And who am I missing?
Travis.
Travis. And you guys, you and your brother, are you sole proprietors?
Yeah, my brother and I are sole proprietors, but on the family farm side of things, I guess. Part of the farmland is owned by my parents as sole proprietors, and then on the other side, it's owned by the corporation, and then the corporation just rents the land from my parents. So
yeah. Okay. 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 So really, the purpose of financial statements is for measurement. So if you don't measure the right things, you want to make sure the right things get done, and having the key indicators by using your financial statements really helps. In fact, it's crucial in terms of identifying it and taking steps to make changes based on the numbers. So one of the key things you want to be conscious about is identifying a few things to start to keep focus. If you are trying to identify 10 different key indicators, then that becomes a bit of a challenge. So I think if you want to focus on a few, that's important. So it's to identify what those are. And if you recognize and reward desired results, they may be repeated. So that statement really tends to focus on if you have employees. One of the things we talk about in C-Team is, do you share your financial statements or some information in terms of your financial performance with your employees or your staff, and are they rewarded in terms of incentive if they're able to increase or they have an impact on those financial statements? So that's where if you recognize and reward desired results, they may be repeated. And in fact, that's true even with family. The more everybody's aware of what's going on in terms of the measurements, it is incentive to make things happen. And it comes back in even in terms of compensation. So is compensation aligned with what's being measured? So these are some of the things that we want to take into consideration about why we're doing this and why they're important. So the financial statements, and I guess that's why I asked who's filing corporately and who's filing non-corporately, because there are some differences, and we're going to talk a little bit about those differences and what needs to be done to take your tax statement and to make it an accrual statement. So the non-corporate, either you're filing as a sole proprietor or as a partnership, and that is simply a tax-based, cash-based filing. And so the corporate statements, there's 3 different levels of reporting for the corporate statements, and they basically give 3 different levels of assurance from the accountant standpoint. So you will have the notice to reader, you will have the review engagement, and you will have the audited financial statements. Lots of times, or typically, it's the lender who will, depending on where your financial position is or your debt or how much you're borrowing, will dictate, or they will have required level that they will want from you in terms of what you get done from your accountant. And in terms of, I know with different organizations, I've worked in one where it's been government funded. Obviously there it's an audit statement because there has to be the accountability, the transparency, and everything in terms, because it's government dollars. So the 3 different levels of statements you just want to be aware of if you incorporate and what you need to do. So I talked about the cash versus the accrual statements. So most farms, if you're corporate, non-corporate, you file taxes using your cash basis reporting. So cash basis is basically you record the cash when it is deposited into your bank, and you record the expense when you write the check. So the advantage, obviously, to us farmers who, on the cash basis is we can manipulate when those expenses. So we can pre-buy that fertilizer before necessarily taking delivery. You can, but you can use that expense December 31st. So it gives you the opportunity to be managing your cash flow, and I think that was one of the reasons that they really wanted to retain that cash basis for farmers, as it is typically an advantage for us in terms of managing your cash. Your accrual basis, though, its revenue is recorded when it is earned and expenses are recorded when consumed. So it's not necessarily when the check is written. If you have an invoice for it, you're going to enter that invoice into your accounting system, and it is already considered as an expense, even though you have not paid for it. Or if you have shipped grain out, it is already recorded as income the moment it left, and you've sent out an invoice, or you have your bill of lading, you're going to record that as an accounts receivable. So it's a difference on how it's recorded, but it's to understand that the accrual statements are based on an accrual basis, so they're not the same as a cash statement. So financial statements that we're using for management purposes are typically accrual statements because they give the complete picture of what that year brought in terms of your production costs, your production, and your management costs. So in order for those of you who are sole proprietors to make your cash statements usable as accrual statements, you need to have some adjusting entries done. And one of the things I like with Agri-Stability and Agri-Invest is it forces you at the end of your year end, even if you're a sole proprietor on a cash basis, you have those inventories and what those amounts are. So you do have the ability to make those adjustments so you can get accrual statements off your cash statements. And what are some of those adjustments that need to be made? So your prepaid expenses, so those are expenses such as insurance that you've paid out in one lump sum for a year in advance. So saying you, say your year ends July 30th and you pay your insurance in May, you've used only 3 months of that. So the balance of that insurance premium for the other 9 months would be considered a prepaid expense. So you have to account for that. It's not a full write-off when you write the check. Your accounts receivable, so what do you still have owing coming in on those grain sales that went out the door but you still have not received a check for. Accounts payable, so obviously you may owe suppliers, so it's accruing what those expenses are and to take into account within that financial year. So there are some adjustments, and your inventories also have to be adjusted. So if your year end is December 31st, what is the difference in value in your inventories from last year, December 31st, 2017 to December 31st, 2018. So these are all adjustments that need to be made to make your cash statements an accrual statement. So for sole proprietors, as those of you who are already corporate, those adjustments are made and you can use your financial statements as presented. So let's talk a little bit about the statements themselves. The income statement, also called profit and loss, it reports the revenues and expenses. It'll give you the margins, so your gross margin, your contribution margin, and your net profit for a defined period of time. So it will always be over a span of time. So if you look on an income statement, it will say for the period of, and you can use it comparatively to measure periods against other periods. Your balance sheet, it reports your assets, current and long-term, and your liabilities, also your current and your long-term assets, your liabilities and your equity at a point in time. So you would be measuring your balance sheet, the values as at December 31st, 2017. What are your values on that particular day? And you can again use that as comparative against to the balance sheet the previous year. The cash flow statement, it reports the sources and the uses of cash for a defined period of time. So when we take a look at it, it will cover your expenses for your operating, so what goes in, what comes out, your investing, what goes in, that's your asset purchases, and what goes out, as well as the financing, so what loans you're taking, what new loans you're taking, and what principal payments you're making. So that's the cash flow statement. It is different, as I said, than the cash flow projection that we do a year in advance. So it's taking a look at the year gone by and how the cash was used over that year. One of the things we don't talk a lot about, but are really important to understanding your financial statements, are the notes to the financial statements. It gives clarity and a lot of information in terms of understanding them. Sometimes you can take a look at somebody's financial statement and make some assumptions, but it's really imperative that you read the notes behind it. So it gives us supporting information, talks about your debt, the terms, any going concerns, and accounts. So those are an important piece to the last part of your package. So Larry, I'll let you, do you want to talk about the structure of the financial statement and how we're looking at standardizing it? And this is the format that we're using.
Yep. Just a minute. Okay. So I hope you got this version, because it said 12 lines before, and I counted them up, and it's actually 14. So here are basically the things we're going to do. Is I don't think we have these cost categories defined on another slide, do we, Heather?
Nope. No.
Okay. So at the top line is your revenue, or it says here sales, but we can call it revenue. And what I like to do is to make sure that the revenue is revenue from farming. So what does that mean? It means that if you have an asset that you're carrying on your books for $20,000 and you sell it and you get $30,000 for it, that's not revenue. That's going to go down below where you see it. I can't see it on my page, but it should be other income and expenses. That should go there. If you're going to get government payments other than crop insurance, that's not revenue from farming. That goes down below. I like to tease people, you know, if you got a race car that you're losing money on and you write it off against your farm, well, that's nice, but put it down below. So this should be revenue from sales, and it should have included in it should be I do put in crop insurance payments, and I also put in changes in inventory of the product. So if you're a grain seller, your change in inventory should go in here of the grain. If you got fertilizer in inventory, then it doesn't go there; it goes in the next line. Okay, so
Larry, can I get you just to address custom work?
Say again.
Can you just address where you would put custom work?
Still didn't hear you. Sorry. One more time.
Could you just address which category you would put custom work? If anybody's doing custom combining, custom seeding.
Yeah, that's always a question, and the answer is generally if custom work, and it's the same question whether it's custom work that you're getting paid for or custom work you're paying for. The answer is generally if custom work is a major part of your business, then it should go in your revenue line. If it's not, then it could be down below. But the bottom line, what I find, and I don't know whether you and I have talked about this, Heather, is what I find is that if it's not a major part of your business, it's not going to be material anyway, so it really doesn't matter very much. Yeah, that's a better that's best answer I can give you. Most people are now including it in the revenue. You can take it down below into the other income, but that's my bottom line. And the same on the cost of goods. If you're, and this is one of the biggest problems we have is how to figure this one out. But if you're paying custom work, we usually record it in that category called direct operating expenses. And again, it's the same question: is it material? If it is, then it should go in there. Okay, is that okay, Heather?
Yep. Yeah. I know if there is some people that do it, it is a question.
Yeah. We actually talked about it today. Again, cost of goods sold. My definition of cost of goods sold is it's the stuff you buy that you're going to turn into a final product. So if you're a grain farmer, it's seed and fertilizer, chemicals, that sort of thing. If you're a livestock farmer, it's your feed and your feeder cattle. If you're buying feeder cattle, again, vet medicine and so forth. If you're in the horticulture business, obviously, if you're annual, it's the same as what it is for crops. If you're in the apple business and the cherry business, the way I treat it is that I've never run into anybody, Raj, and maybe it's different for you. I've never run into anybody who treats their trees or bushes as a capital item. They usually the way that's categorized is to change. If you planted some new trees this year, it's going to go into your cost of goods sold. Is that the way you do it?
I believe so. I said I believe so.
I still didn't hear you. Sorry, say it again.
I said I believe so. That's like this. What you said. That's the way that we do it.
Yeah. That's what everybody I run into does. So that would go in there too. And okay, so then we subtract that off, and that gives us a gross margin. And it's a very specific definition of cost of goods sold. And it's a very specific definition of gross margin. Everybody does. I see as many definitions of gross margin as there are definitions, frankly. So that's mine, and we're doing it this way because we're actually doing a bunch of benchmarking, which I'll talk about in the next or one of the sessions coming up pretty soon. Okay, then direct operating expenses for me is the cost of your operating labor. If you pay yourself a salary as a manager, I think you should put that down into operating overheads. And then if you also do work on the farm, you should separate out the operating labor from payments from the management payments. Hardly anybody does, but that would be the best way to do it, I think. Then the other pieces that are in there are, if you think about the value chain from Porter, you've got inbound logistics, so the cost of shipping inputs in, if you pay for them, would be in there. You've got outbound logistics in here that would be the cost of shipping product to market. And your repairs and maintenance and the operating costs for your machinery and equipment go in that one category. The way we're doing it, we are not including rental payments. We're not including lease payments. We're not including lease and rental payments don't go in there. They go down in the capital component. Okay, so this is definitely an operating category. We subtract that off of gross margin. That gives us contribution margin. Okay, then my operating overheads would be management salaries, office salaries, keeping the lights on in the office if you have them, insurance other than crop insurance, lawyers and accountants, courses like this if you paid for it, things that are not directly related to production, but that are annual operating expenses. And we subtract that off. Lots of people get the EBITDA by going backwards from profit, but I like to do it forward. So we subtract that off, and that gives us EBITDA. So, and interestingly to me, the two categories, the cost of goods sold and the direct operating expenses, are strictly variable costs. They are going to change with their level of output. and the operating overheads are kind of quasi-fixed. So if you buy a new quarter, you probably aren't going to change how much you pay your accountant very much. It's not going to be directly related to it, for example. But these are from EBITDA up, it's all operations. Below EBITDA, it's now capital. So the next category, I actually, I've got it in here. We call it cost of capital now, but we put in depreciation and amortization, which basically is now the same thing. It didn't used to be, but it is now. Your leasing costs and your rental costs go into that next category. So the reason we're doing this, there's two reasons we're doing it. The logical reason is that whether you lease a piece of machinery or whether you lease a piece of land or whatever, especially machinery and buildings and so forth, or whether you own it, it's another way. It's just a different way of acquiring acquiring assets. So I want to treat capital separately from the operations part. So I put them together down here. We subtract that off, and that gives us earnings before interest and taxes. And then we subtract that off, and that gives us we subtract, then from that, we have the interest expense. And I would combine the interest on both operating loans and mortgages here, and that gives us earnings before taxes. Then we take off the taxes, and then down here is the plus or minus of the dividends or other income and expenses. And I can't see it on my screen, but the one below that should be net profits. When I'm looking at profitability for an operation, and again, we'll see this hopefully later on, I'm going to be looking at earnings before taxes. I'm not going to look at net income because that's got all that other stuff like government payments and gains and losses on disposal. Earnings before taxes is my measure of profitability. Okay. And then you said you're going to go for an hour, and it's now been an hour, by the way. Heather, are you there?
Yes, I put myself on mute again. Just,
Oh, okay.
Sorry.
It's okay.
Okay. So yeah, any questions on how Larry presented the standardized format that we're looking at?
You'll see when we talk about this why I do this. I can actually, every farm, no matter what they're producing, buys stuff and turns it into another product. Every farm has some kind of equipment, and they usually order labor, pay labor, so I can compare across farms. Every farm has a set of operating overheads. I can compare across farms. So I really like this because it allows me to benchmark one farm against another, and I'll see. Travis has already seen this once, but we can really come up with some benchmarks that are quite useful. They will be different by type of farm. So I wouldn't expect Roger's ratios to be the same as Curtis's by any stretch of the imagination, but some of them will be.
Okay, good. Thank you. So we'll move on to the balance sheet. So typically we have an analysis on your assets, your current assets, your fixed assets, and your other assets, your current liabilities, your long-term liabilities, and your equity. So typically we take a look in terms of the current, which is items that can be, so in terms of your assets that can be cashed in, that are liquid, and your current liabilities, anything that is due within that year. So whether you have an operating loan, your current portion long-term debt, your taxes, those are considered in your current liabilities. Your fixed assets, your machinery, your equipment, your buildings, your land, and the other investments. So I would say this is where that Merrill Lynch document gave you a pretty good explanation about what each of these categories include, keeping in mind that it's as of a specific date. Some of the things you want to be conscious about are in terms of the values, and we'll move on. But the thing I do want to just actually note is on the bottom where it says your total assets equal your total debt plus the equity.
Good.
So that's something that you really want to, that's how it all balances out. The left side has to equal the right side.
And that's one of the things that's really hard for some people to grasp for some reason. You know, you've got this whole total set of assets on the farm. There are only two ways you can have finance them. One is with your equity, and the other is with your debt. There are no other choices. So debt plus equity have to equal assets. And maybe this is obvious to everybody, but back up on the fixed assets, if you have one set of machinery and equipment, its value this year will be whatever it was last year minus its depreciation. The same with buildings. Okay, so if you don't add to them over time, your assets and building, or sorry, your machinery, equipment, buildings are going to be going down in value because of I use depreciation. Accountants screw it up by talking about. That must be Heather's phone.
Sorry, I just hung up on whoever it was.
They will call it amortization too, but it's the same thing.
Okay. One question, and I know this is a thing for lots of us. In terms of land, there are a number of us who do keep land outside of the corporation that we're still holding it in our personal name. In your balance sheet, Larry, are you including the land that's being held personally, or when you're looking this from an analysis point of view? Or just from the company?
I like to put them together if I can, because yes, I understand why you're doing it in two different operations, but if you really want to get at what the profitability of your operation is, you gotta have both of them there. I mean, there's all sorts of issues. We had a lot of argument today about whether you, if you're doing return on assets, and this doesn't really relate to your question, but do you do them at cost or you do them at market value? I'm going to start with cost myself, and you can always change it to market value. But if you're looking at profitability and you're using the land and you got the land in a different corporation, you can't tell anything at all about your profitability if you don't come in. Or you look at your debt. Is the debt in the corporation going to relate to the land, or is that going to be someplace else? And if the land is owned in one place and the debt's in the corporation, again, you're skewing it not to put them together.
Okay, so I wanted to bring that up because obviously when you get your financial statements as your company, that personal land will not be reflected in there. So if you want to be looking at that, that is one of the things you need to consider in terms of making an adjustment there.
Yeah.
Okay. So we talked a bit about the current assets and the cash management. So in terms of a company with high cash, they obviously have high solvency, but it's also dampening their profitability because they're sitting with this cash in the bank and it's not generating them perhaps some of the opportunity or the revenue that it could be through other investments. However, if it's low cash, you could have a solvency risk, but depending on how you've invested that cash and where it's sitting, it could be enhancing your profitability. So you really want to have a good grasp on where your cash is, your current cash, your current assets, and how you're using it the best possible way for returns. So for cash management, obviously we talked about speeding up receipts, so speeding up those checks coming into you, but perhaps slowing down your payments a little bit and taking advantage of the supplier credits timelines in terms of payment. So that's basically managing your payables and your disbursement process yourself. So receivables, same thing, terms of sale. being aware in terms of the quality of the customer, credit and collection. Typically in grain sales, I can speak from our experience, with the big elevators, you're not typically concerned, but I know when you're selling barley to feedlots that you're not really aware of, you really do want to make sure you have an awareness of who that company is in terms of getting paid. Using your inventory, so the raw materials and your finished goods, depending if you're in value added and what you perhaps are doing or making, the work in progress or the finished goods may apply to you. And making sure you're utilizing that inventory and controlling that inventory appropriately. And the others, so the prepaids and your taxes receivable, as well as your current portion long-term debts. So those are some of the things you really want to be considering when you're looking at your current assets and how to manage them and the uses for them. So your current liabilities, same thing. You're going to have some short-term things that are provided by your suppliers, so your accounts, what you are paying out to others. Your accrued wages, so you're going to have your employee payments due, going out to your staff if you have employees. Your accrued taxes, so that could be your source deductions or your GST. Your trade credit, that's where you're payable to your suppliers and depending on what their timelines are. And your short-term loan, so that would be your operating line credit facility, which would hopefully be revolving. Your current portion, your long-term debt, so that is taking a look at all your payments and identifying what principal on all those payments is due in the next 12 months. And so the things you want to be thinking about when you're talking about your current liabilities is your liquidity, so out of your current assets, and your current liabilities, what movement does that give you, or what potential or what ability does that give you for cash flow? Your leveraging, your buffering. Obviously, if you have cash on hand, it buffers you from emergencies or unforeseen events. So it gives you the flexibility, increased interest cost, and security. So those are some of the things that you want to be considering in terms of your current liabilities. Your working capital, it's calculated by taking a look at your current assets and subtracting what your current liabilities are. And what's left is your working capital. And so it's giving you the amount of cash for your operating, measures the amount of cash available for all the current liabilities have been paid, and it gives you that flexibility. So obviously the more working capital you have available, it gives you the flexibility to take advantage of those opportunities when they come up. For somebody who doesn't have and is on kind of in that yellow zone in terms of when we start looking at appropriate levels of where you should be, it gives you that step and that strategic advantage. So working capital is important. And it measures your short-term liquidity. So obviously the greater the current assets, the greater the liquidity, and the greater the current liabilities, the greater short-term need for cash. So those are the things when you're talking about in terms of your cash flow projections, things to watch and calculate when you're putting it together. One of the things I wanted to talk about a little bit in terms of the balance sheet is book value versus market value. Typically on our corporate financial statements, we're using book value. So book value means what was it how much was it that we bought it for? And then it is adjusted using the CRA rates of depreciation each year. So the asset book value doesn't always reflect what the current market value of that asset is. So when you're looking at your balance sheet, you want to be cognitive of that fact. So the book value may be less than what that asset is actually worth. So one of the things I know on our financial statements, we use management rates on our financial statements. So obviously for class 6, the CRA rate is 10%. As a management rate on our financial statements, we're using 5%. And so looking at class 8, you can see the differences there in class 10. And that's giving us a better reflection of what that asset is worth. We obviously still do a market value annually on our equipment, so we still have, we're keeping a spreadsheet which gives us a better reflection of what those values are, but this is much better than what the CRA rates are, which we definitely use for our tax filing. So just to make sure you're aware of the differences when you're looking at your balance sheet. So the last one we want to talk about is the statement of cash flow. And this really is a reflection of where the cash is either going or where it's coming in from. So it comes from three sources. So we look at operations. So we're talking about if the money's going out, what we're using it for, or if the money is coming in. So we're looking at the operating earnings coming in, our expenses going out. We have interest, we have taxes. So typically you want to be looking at that, and hopefully it's positive that you're netting out in terms of the cash flow coming in from operations. Investing. So this is where we're talking about purchases of assets or dispositions. So where it's saying there's a plus sign above in that the cash from or to investing, it really should be a plus and minus, because you can be selling or you can be buying. So you want to be taking a look at, is it, what impact is it having to your cash? Is it going up or is it going down? So that is with assets and investments and capital investments. And then the same we look at in terms of financing. So are we taking on new debt? Are we taking on new loans? Or are we repaying the debt? Deferred taxes or the shareholder payments, are we paying it out, or are the shareholders making contributions in? So this really takes a picture, and it starts from your cash balance at the beginning of the year. It takes your cash, the net cash from your operations, from your investments, and from your financing, and it will balance what your end account is at the end of the year. So it's not reflective of your profit. It's basically a reporting of how you've used your dollars. Larry, do you want to add anything to this one? I know this is one we always, it's not a common one that we use a lot, but it is reflective in terms of how you're using your dollars, so it needs to be looked at.
No, you're doing fine. I don't have anything to add.
Okay. Okay. So that's basically, just to summarize, we talked about the income statement, reports revenues, expenses, the balance sheet. It talks about your financial structure on assets and liabilities and equity, and our cash flow statement. So like I said, those are the three. And then again, always remembering to review the notes for the clarity of the information that you're looking at. Any questions in terms of any of the statements or anything that we've said?
Probably buried under all the financial stuff.
I know it feels like it is a dry topic, and but we really just wanted to get you the basic understanding of the financial statements before we move on. And if between now and the next session that we have, you have any questions, don't hesitate to ask. And I'm sure we'll be recapping a lot of this when we start getting into the ratios and the analysis. So I guess it's the three questions that we would like you to stop and think about in terms of when you're thinking about your internal analysis. So what differentiates you from your company's financial position from somebody else's, your competitor? What gives you your greatest financial strength? And what is your greatest financial weakness? All three of these questions have an impact in terms of your abilities, your opportunities. So that the three things we really want you to stop and consider when you're putting together your analysis. So for those of you who've already sent yours in, you could certainly add this in there if you like, because it does have an impact. And for those of you who haven't, think about this and make sure you include it. And I think that is all I have, unless you have anything else, Larry, that you want to add?
Yeah, well, we have to figure out when we're going to meet again.
Yeah, we will. Just
Okay.
if you have anything else Want to add on onto this presentation?
I don't think so. I don't think so. Partly because I'm really getting hungry.
Okay.
Larry and Heather, do you guys have a like a software program that you recommend for keeping track of farm financials?
Well, there's enough. So there's an accounting program.
Mm-hmm.
Who asked that question?
Travis.
Yeah. Okay. Well, a lot of people like Ag Expert,
Mm-hmm.
which is the one I think Farm Credit uses.
Yep.
I know Heather. Are there others?
There's Simply. There's
Simply.
QuickBooks. They're
QuickBooks.
basically generic, and depending what you're looking for out of them, I use Simply. Simply because when FCC came out with Ag Expert at the time, we were incorporated, and you couldn't do your adjusting entries until you got your stuff back from your accountant. It just didn't make sense. But I think it is a good product as well. It gives you good ratio analysis.
Which one, Simply or
Nope,
Ag Expert?
Ag Expert. It gives you some good insights, I think, for sure.
Okay, so Ag Expert is sort of the general recommendation, even though it's going to vary depending on your needs.
I don't hear very many people say bad things about it. What Heather's implying, I think, is that it's either kind of that or some other. I mean, there are some other programs out there that are particularly for farms, or alternatively you take Simply Accounting or QuickBooks and build your own.
Okay.
I use QuickBooks. I'm not for farming, but for my own business stuff. But I don't know, Heather. I can't even remember the other ones I hear anymore. Besides that are pre-programmed. Besides Ag Expert.
Yeah, there's not a lot really. I think those are kind of the main ones. And I think it depends, like if you get comfortable in setting up spreadsheets and taking your data from Simply or from your financial statements and making your own, building your ratios, I think you can easily use Simply or QuickBooks.
Okay.
Yeah. Okay, so.
Okay, so I failed to get us done by, I have 6:30, but 7:30 for you guys. I apologize. I really thought we would, but in terms of the next session, next week we are in Montreal and Ottawa for C-Team. Does the following week, the 29th or the 30th, work for the second financial presentation?
Yes, that Monday looks good.
Okay, any objection? How about we do it that way? Any objection to doing it the evening of the 29th? Okay.
There's no objections. I'm going to suggest we go to the 29th, and that will be great. That will really work well for me.
Okay, so let's plan on that. For those of you who have sent in your things, I've got some comments. I'll be getting them out to you here in the next couple days. Larry, you're going to have a conversation with Travis.
Yeah.
Carmen, can we connect tomorrow?
Let me just look. So tomorrow I am free at 6 o'clock.
Okay, 5 my time. Okay, that works. I will send you a go-to for that.
So you're both in Alberta. I think that I'm talking at the same time as you.
No, I'm in Palm Springs.
Oh,
sorry.
Sorry.
Yeah. No, that's okay. So no, I can do that. And then
some people question it, Carmen, but she does know where she is.
Thank you. Okay, so everybody, I can't even talk. I'm getting tired too. Thank you. I appreciate your listening. Like I said, it is a bit of a dry topic, so it's a lot to listen. And if you have any questions, please don't hesitate to contact either Larry or myself.
Great, thank you both.
And we will, I'm going to stop recording in a second, but